Welcome to FinBuild classes. In this session, we'll be continuing the basics of bond. Before delving deep into bonds, let us know what are debt securities. Debt securities, such as the bonds, are financial instruments executed by the issuer who sells them to investors to raise funds. The debt securities have maturity date and a face value that we have already discussed in previous session. Now we know that the bond holder or the investor has lent money to the issuer by buying the securities. So, investor definitely requires the compensation or the return for lending the money. But the return depends on number of factors. So, what are those factors? First factor is the credit risk. The risk that issuer may default in paying back the return and the face value on its maturity. From this we can interpret that higher the risk, higher the desired return. Second factor is the inflation. We know that inflation reduces the purchasing power of investment. Expecting a positive real return, we need inflation adjusted return. Third factor is that we have the time to maturity of the instrument or the security. Longer the maturity, greater is the uncertainty, as the demand and supply of debt securities will vary. Debt securities are referred by various names, like bills. In short, we call it as bill of exchange. Then we have T-bills, which is issued by central government, called treasury bills. Then we have notes. In short, we call it as promissory notes. Then we have G-Secs, short for government securities when issuer is central or state government. Then we have debentures issued by corporate entities. Apart from these, we have debt securities with embedded options, which could be in favor of issuer or the holder of the instruments. One of the example is nothing but the convertible bonds, that is converting into equity share capital. One more factor that has to be discussed is the form of interest payable. The interest payable on a security is either at a fixed rate or a floating rate. The actual rate of interest payable on the security is refixed periodically, say 6 months, based on benchmark market rate. The annual interest is often referred to as the coupon. The periodicity of interest payment is not necessarily annual. Say it could be quarterly or monthly. So we have discussed lot of terminologies. Have the Reserve Bank of India's 8% saving taxable bond. So they have given the features of the bond. Here they have clearly mentioned who can invest, what is the issue price, what is the periodicity of the bond, the limit of investment, how the tax treatment is done for the bond. Then we have the maturity and rate of interest. Then the bond is whether transferable or not. So when we say who can invest, the bonds are open to investment by individuals, institutions or universities. Here it has been clearly mentioned that the NRIs, non-resident Indians, are not eligible for making investment in these bonds. So every bond has its own condition or the features which is given by the issuer. Here the issuer is nothing but your GOI, the government of India. Okay, so RBI is nothing but he is an issuer acting on behalf of the government. In this we have the issue price. The bond will be issued at par, that is 100%. So here they have given the face value of the bond, which is nothing but 1000. Face value is nothing but the 1000, which is here, which is your initial value of the bond. Then we have the period. They have given that it could be issued in cumulative and non-cumulative forms. So I'll be helping you out in breaking the terms of what is cumulative and non-cumulative forms in the upcoming lectures. Then we have the tax treatment that they have given is on the income tax, wealth tax. There is no wealth tax now, so they have exempted it. This is very important, right? Maturity and rate of interest. The bonds will have a maturity of 6 years, carrying interest rate at 8% per annum, payable half yearly. The cumulative value of rupees 1000 at the end of 6 years will be 1601. So in the end they are paying you the principal amount back 1000 plus the rate of interest. Here the regarding the transferability, we can say that the bonds are not transferable. It means that it is not there is no embedded option over here. So it is not embedded bonds. So we have discussed a lot of terminologies in this session. See you in next lecture. Don't forget to subscribe and share. Thank you for watching.